So it has been a crazy year. It's been a year that's been dominated by all the uncertain moments.
Obviously, in the early part of the year, we had a pretty dull period when the market effectively went on hold, pending the Brexit outcome.
In terms of low light, it's more the market which has slightly gone down in central London.
Well, Article 50 has been a bit of a challenge, and Brexit questions are still outstanding.
The low for me was probably in July, immediately after Brexit, where a number of the UK retail funds gated their funds. And the market overall, I think, has been pretty resilient.
What we've seen in the autumn and lead up to Christmas now is renewed activity in both the leasing and investment markets.
A weak sterling has really been a significant positive push to bring foreign investment into England.
2017, more uncertainty depending on when we trigger Article 50.
I think it's not just a question of whether Article 50 is triggered or not, it's what else will the government announce. The real question on Europe is whether the EU project will survive.
The ambition of the government with regards to housing and infrastructure is quite impressive. For a contractor developer such as Linkcity and Bouygues UK, I think it's a fantastic news. In 2017, what we expect is a market which is going to go slightly down in terms of housing price in central London.
We are now seeing a pretty seismic shift in the way in which the way in which properties are being sold and the number of properties that are going to be available. Most first-time buyers will be looking at the new build market and hoping that the government and the house builders continue to put more and more stock on the market.
One of the biggest challenges we're going to face next year is to continue to build high-quality, original homes in good locations against what is certainly going to be an uncertain year from a political and economic viewpoint.
2017 will see the build-to-rent market mature as more schemes come to fruition, and for me, the build-to-rent market looks bright for the year. There are some big players, L&G, M&G. Land supply will be an issue. I think we have to look at planning. The younger generation aren't necessarily focused, as perhaps my generation was, of buying a home. They are probably going to be looking to rent a home, and therefore the image and the branding for build to rent is going to be very important.
The planning system is in disarray. We're finding that planning applications, which would normally take between 8 and 13 weeks, relatively modest planning applications, are currently taking between 12 and 18 months.
When you have economic uncertainty, there's definitely a greater requirement for the need for flexibility.
Rents are probably under pressure, particularly in some of the office markets.
We're already seeing a continuation of strong occupier demand for well-located and well-specified schemes in central London.
Stations and more central locations have always been of interest, but what we're seeing now is it's moving further out.
But what we're going to see, I think, moving forward is a greater mobility as people move around London more.
Regions occupy a unique position in the UK property landscape. Cities such as Birmingham, Manchester, and in that sense, they offer great value.
So the challenges that faces 2017 for retailers is the online shopping. There's been a 27% increase on consumer spending online. So because of the terrorism threats being severe in the UK, CCTV cameras, especially with thermal cameras, are in need in shopping centres.
It's more and more difficult for on-street retail to survive. So they need to organize themselves, they need to be properly managed.
Disruptors will certainly increase their market share in 2017. High street agents need to start to think about how they can sell their services better and how they can upsell their expertise and their ability to get better prices.
I think a highlight for the market is going to be the return of foreign investors, in particular to central London, acquiring some very good quality properties at strong prices.
The private investor has certainly seen the light and has been dominating the investment market, particularly for the smaller lot sizes.
Our forecasts are pretty much of a stable but low growth for the next, I would say, 12 to 18 months. And hopefully none of the elections will move it off kilter in terms of that forecast.
2017 we feel is going to be very exciting for peer-to-peer. The sector itself is now worth approximately 6.5 billion. We see continued growth and significant growth at that. Tightening in legislation absolutely is a good thing because ultimately it protects lenders and borrowers on peer-to-peer. What it will do is it will increase consumer confidence, it will raise the profile of the sector, and hopefully it will raise awareness as well so that people have the confidence to lend their money to platforms, and at the same time borrowers have the confidence to go and raise funds.